Your thoughts? What if it goes below 1%? I mean, does that have real implications for the market or just psychological ones?
No, it's real. I mean, you have the benefits of the consumer that wants to refinance or the person that's looking to buy a home. But look what they're doing to the bank stocks. We've already given back yesterday's rally. We're damaging the profitability of the banking sector. And if one of the transmission mechanisms of monetary policy is the banks in order to encourage them to lend, well, squeezing their profit margins is not good for potential loan growth, especially to small and medium-sized businesses that rely on the loans.
Absolutely. We had Gerard Cassidy earlier, though, say, look, there's going to be a refi bonanza that could be something of a tailwind. Hold that thought.
That'll be the one area that's profitable for them, but the loan margins are going to get squeezed.
Right, and that's more transmission to the real economy. Let's bring Rick Santelli back in here. He's out at the CME. Obviously, Rick, watching to see if it happens today or in the next 10 minutes here.
Well, I was just getting ready to take a picture because I see 9999. There we go. Snap the picture for history. I think I'll send a copy to Janet Yellen, Ben Bernanke, and maybe Jay Powell. Mission accomplished.
Yeah,
yes.
That's all. I mean, to sit here and look at it below 1%. Peter, one more thought, and then I want to go to Rob.
I mean, we're following the policies of the Bank of Japan and the European Central Bank, and how did it work out for them?
Rob, let me bring you in on that point. You know, as you sit with all the experience you've had advising different presidents and so forth, what would you say about the president's call for the Fed to do more here? Is that the right channel? Should he himself be coming out with fiscal stimulus, or do you let the market? What do you think? I'd just love to hear your thoughts.
Well, the fact is that interest rate cuts just don't cut it in this kind of situation. Interest rate cuts encourage people to invest and to buy if they think things are going to get better. They don't have that effect if you're in a downward spiral of expectations, which is where we find ourselves now. So this will have no real effect, I think, on the overall economy.
Rob, what would you know, today also happens to be Super Tuesday. Let us not forget, you know, we're getting very close by the end of the day to figuring out who the Democratic nominee for president will be. What should that person's message be about rates and the economy?
Well, I think the message is I can bring back stability and security to the U.S. economy. The fact is the administration is very vulnerable on the coronavirus because they cut funding for the CDC, for NIH, for WHO, and they eliminated the Pandemic Disease Task Force. Well, that is going to come home to roost if, in fact, this pandemic becomes very serious, which it looks like it may very well be.
Peter, what are your thoughts on how this all plays politically? Let us not forget an important part of what happens with GDP growth from here, with interest rates, with all the rest of it, is going to be what does this do to guarantee or not the president's reelection in the fall? Well,
I mean, historically, we know the summer leading into the election, the state of the economy is going to be a huge driver about who's going to get that election victory.
What would you say to investors who are just looking? We had a discussion earlier about the kind of this reach for safe yield and there being nowhere to go. Yes, you're holding on to capital gains if you're holding bonds, but that doesn't necessarily help people achieve what they're looking for. Does it push everybody into the stock market, into dividend stocks? I mean, the defensive names like Art Hogan was warning off the top don't think they're defensive if they're trading at all-time high multiples. Right.
It's extraordinarily difficult. The Fed's lift to someone, it's an impossible situation on how to safely make money. And being in bonds, stocks, gold and silver, and very diversified, not just your standard bonds and stocks, but very diversified, I think is the only way getting through this. But it certainly has been made more difficult from an investing standpoint.